Last time we called buying Palantir at a 100 times sales valuation a prayer. Well, Q1 2026 is officially in. Today, we find out if that prayer was answered or if it just got significantly more expensive.
We're looking at a massive, glaring contradiction today. Palantir just reported the fastest revenue growth in the entire history of the company, yet the stock is sitting 30% below its all-time high. It's a fundamental disconnect between business performance and market pricing. Let's dive right into the numbers.
Let's start with a trigger. Total revenue grew by 85% year over year to $1.63 billion. Listen, mature software companies usually decelerate at scale. They hit the inevitable law of large numbers and gravity takes over. Palantir just completely defied gravity. They accelerated.
And they didn't just grow, they became a mathematical impossibility in the software world. The Rule of 40 score skyrocketed to 145%. Let's keep this very simple. Hitting 40 is considered elite. Hitting 145 is a statistical anomaly. As Alex Karp noted, this effectively removes Palantir from the software category entirely, bumping them straight into the NVIDIA and Micron hardware tier.
Furthermore, they didn't just beat estimates for the current quarter. They raised their full-year 2026 guidance by a massive $400 million, targeting over $7.65 billion. That is 10 full points above their prior guide. Make no mistake, this is not just a standard earnings beat, this is an absolute compounding acceleration.
Let's rapid-fire this financial snapshot. We start with $1.633 billion in explosive top-line revenue.
Look at the underlying profitability. Adjusted operating income came in at $984 million. That's a massive 60% adjusted operating margin, pulling in $925 million in pure free cash flow. Software companies just don't generate cash like this at this stage.
Add to that a staggering GAAP net income of $871 million. They are completely fortified by an $8 billion cash pile and, listen to this, they carry absolutely zero debt.
But there is one specific red flag the market immediately caught. U.S. commercial revenue hit $595 million, slightly missing the $605 million consensus. Why does one tiny miss matter? Because when your stock is priced for absolute perfection, the market zeroes in on the one single metric that didn't completely shatter the ceiling.
And that brings us directly to the price action. The stock closed at $146, dropping another 2.7% after hours. That keeps the valuation heavily compressed and roughly 30% below its recent $207.52 high. The multiple finally compressed. We're now at roughly 45 times forward sales and 110 times forward earnings. But listen carefully. The multiple compressed, but only because earnings grew so insanely fast. The fundamentals are literally sprinting to catch the price. Will they ever actually meet?
Let's look closely at the AI angle, because this is where the real momentum lives. Net dollar retention hit 150%. This means existing customers aren't just staying on the platform, they are expanding their spending by 50% year over year.
The broader U.S. revenue grew by 104% year over year, while the specific U.S. commercial segment exploded by 133%. AI platform adoption is going completely viral across industrial titans like Airbus, Stellantis, GE Aerospace, and Bain. Compare that to the rest of the market. C3.ai just reported negative 19% revenue. That's not competition, that is collapse.
Palantir's product ROI fundamentally breaks traditional bloated software sales models. Karp made the core mandate crystal clear when he said 70 salespeople. A normal company our size has 7,000. The product is quite literally selling itself.
They're capitalizing on what Karp foresaw as commodity cognition well before anyone else. They built an engine that completely sidesteps the AI slop everyone else is peddling, focusing entirely on pure operational leverage.
So let's stack the bull case. It comes down to three undeniable arguments. One, that 150% net dollar retention. The business compounds from within, and customers simply cannot spend more. Two, U.S. government revenue is up 84%. According to Shyam Sankar, this is Washington's Sputnik moment with Project Maven, and they're funding this, not cutting it, despite Doge. And three, a rule of 40 at 145%. You're getting NVIDIA tier metrics operating inside a highly scalable software business model. This is genuinely exciting.
But now we have to look at the bear case. And the reality here is harsh. First, that forward PE of 110x. Think back to Snowflake in 2021. Their business kept growing, they executed incredibly well, but the stock fell 80% anyway. The valuation simply couldn't survive reality. Second, the international foundation is cracking. The £330 million UK NHS contract is facing intense public scrutiny and serious early termination risks. This break clause is a massive threat to their international scaling momentum. If Europe's biggest healthcare system backs out, the whole global narrative stalls, and Switzerland was already lost.
And here is the closer. At over 220 times trailing earnings, perfection is fully priced in. But look at what the insiders are doing. Over the last 12 months, insiders sold $2.13 billion in stock. Against that, only $1.16 million bought. $2.13 billion sold against $1.16 million bought. That ratio is not a footnote, that is a blaring siren.
Look at how Wall Street is reacting to all of this. We have an extreme divergence that shows total institutional confusion. We have a $20 strong sell target from Monis, all the way up to a $273 bull target. Bank of America raised to $215. RBC says underperform at $90.
Think about that divergence. A 13x spread means the market is not pricing a business, it is pricing a story.
Here are the 4 triggers to watch in Q2 rapid fire. 1. U.S. commercial beats $650 million, confirming acceleration. 2. The NHS contract gets canceled and the international bear case accelerates. 3. DOJ hits defense and government growth breaks. 4. A competitor cracks the ontology moat and it collapses.
So we are left with a massive paradox. Best quarter in their history, stock 30% below its highs, insiders cashing out billions. The prayer isn't answered, it's just more expensive.
Rule of 40 at 145%. Does Palantir finally deserve its price, or is the prayer just more expensive now? It's the ultimate market paradox, and reality is going to catch up to one side very soon.